Now, the third sign that your QuickBooks is wrong is 3 magic words, and those are opening balance equity. All right, so let's talk about this one for a second. When you set up a QuickBooks file and you link your bank account, let's say there's $5,000 in the bank account, okay? What QuickBooks is going to do is, just given the fact that it doesn't have any other information, it's going to take that $5,000 and call that opening balance equity. And it doesn't know whether you put in $1,000 and there was 4 invoices of $1,000 each that made that bank account $5,000, or if you put $5,000 in to start, or if 2 partners put in $2,500 each, has no idea. So what it does as a default is it takes that $5,000 and assigns it to an account called opening balance equity. Now, once you establish a new QuickBooks file, it's your job as a business owner to go in there and reassign those opening balance equity amounts accordingly until that balance is 0. So whenever I open up a QuickBooks file and I see that account and it's a number other than 0, I already know there's a problem, or at least work that needs to be done, because those amounts were not reassigned to other accounts. So here's an example. I know we're getting kind of technical. Let's say 2 partners founded a business together and they each put in $2,500, right? So in that case, opening balance equity is $5,000. It doesn't differentiate between partner A, partner B. QuickBooks has no idea. So what you would do is create a partner A capital account and a partner B capital account, and you would simply put in a journal entry that assigns $2,500 from that $5,000 opening balance equity to partner A capital account. So there's $2,500 left in opening balance equity. You simply assign that to partner B capital account. So partner A is $2,500, partner B is $2,500. Opening balance equity is what? 0. So we've essentially took all the amounts out of opening balance equity, assigned them to different accounts, and now the financial statements are more representative of what actually happened, because if we didn't do that, we just have one account, $5,000, and that's not really an appropriate amount of detail that dictates what's transpired in that business. And we want our financial statements to be as detailed as possible so we can use them for tax preparation purposes, for managerial purposes, and for the tracking of distributions amongst the various partners. So it's definitely important to stay on top of opening balance equity to ensure that your other reporting is accurate. So let's take a look at how to adjust the opening balance equity account. Now we're going to consider a situation when 2 partners, partner A and partner B, each put in $2,500 to start a business. Now, that would make $5,000 available in the account. So if you created your QuickBooks file on a particular date and there's $5,000 in the bank account that's linked to that QuickBooks file, then essentially opening balance equity is going to start as $5,000. And it's going to be our job to allocate that $5,000 to each of the partners, $2,500 each. So let's take a look at how that's done. Now, on the balance sheet here, we can see the opening balance equity account, and we could click into it. All right, and this is going to show us all the transactions that led to the latest balance in that account. Now, for our purposes, forget everything that happened aside from this first transaction on 5/25/2019. And we can see there that opening balance equity was $5,000, given that that was the amount in the checking account on that particular date. So what we're going to do is go to the accounting tab here, and we're going to create some new accounts for these partners. So we're going to click new over here. We're going to make this an equity account, because essentially if you're making a partnership account to allocate to each one of the partners, those would be considered equity for our purposes. So let's take a look here. We're going to add the detail type as partners equity. We're going to have this account for partner A. All right, and the balance is going to be 0 as of 5/25/2019. All right, because that was the date that that first transaction came into QuickBooks, into the opening balance equity account. So we're going to save that and close. And now if we look, there's a partner A equity account. Perfect. Now let's create the same account for partner B. All right, so this is going to be partner B equity. All right, and we could throw that in the description as well. The balance is going to be 0 as of 5/25/2019. Again, that's that same date. Let's save and close. Just make sure that that's in there. Partner A, partner B. Balances are 0. Perfect. So now we want to hit the suitcase icon up here and make some journal entries, because this is how we're going to make the actual allocation. Now, it's already got the journal date of 5/25/2019, very intuitive QuickBooks. Now, let's take a look at which accounts we're going to use here. So we're going to start with opening balance equity. We're going to debit it for $2,500. All right, and you're going to see here that we're going to label this partner A adjustment. We don't have to get super specific here for our purposes, but let's look at that account here. Okay, it automatically brings the $2,500 in to balance the journal entry. Let's do the same thing for partner B. We can do this all in one journal entry. All right, we're going to debit opening balance equity here. We're doing this for partner B, so let's mark it accordingly. And here, the account is going to be partner B equity, and it's already $2,500. So our journal entry balances. We've got the right date in there. We're debiting opening balance equity, and for partner A, the equity should be $2,500 when all is said and done, and for partner B, it should be the same amount. So we've got the proper descriptions there. Everything looks good. We're going to go ahead and save. All right, we're going to get out of this screen here. So now we've made a journal entry. Now let's go back to the reports. Let's look at the balance sheet, and let's see what happened to the equity section. So in this case, we can see that partner A equity is $2,500, partner B equity is $2,500. Let's see what's going on in opening balance equity. So if we look on 5/25, we've got 3 transactions now, whereas before we had 1. So the opening transaction pulled in the $5,000 from the bank account, and then what we did was we put a journal entry for partner A for $2,500, and that reduced opening balance equity to the $2,500 remaining balance. On the same date, we also have the partner B adjustment, and that reduced further opening balance equity to 0. And that is the magic number. You always want your opening balance equity to be 0. Whenever I open up a QuickBooks file and I see that it's any other amount other than 0, I know there's more work that needs to be done to accurately reflect the situation. But in this case, if we have this proper reporting happening, what we could do is say, hey, let's say partner A takes out $1,000. We can create a partner A distribution account, which is going to reduce the partner A equity account of the $2,500 here. So we can track individual partner contributions, distributions, and so forth, and maintain their capital accounts in QuickBooks, as opposed to just having opening balance equity floating around and not really knowing how those amounts should be allocated. So this is exceptionally useful, and it makes QuickBooks that much more of a powerful tool for accounting purposes. So those are the top 3 signs your QuickBooks is wrong. Now hopefully these tips will allow you to identify issues with your QuickBooks file and also prevent your accounting from looking all crazy in the future. Now if you enjoyed this video, feel free to comment, like, subscribe, and hit that bell icon to be notified of future videos as soon as they're released. With that said, hopefully this was helpful. Thanks for watching. Now you might be thinking, hey Alex, I love your videos and you have great hair, but why should I care about my accounting?
Now don't forget kids, if you're going to do accounting, you're going to need the right footwear.